Now I'm going to read, this is from Wikipedia, what jumping the shark is, because up until last year I'd never heard of this term before. It is an idiom used to describe the moment in the evolution of a TV show when it begins to decline in quality, signaled by a particular scene, episode, or aspect of a show in which the writers use some sort of gimmick to keep viewers' interest. Now, it comes actually from the first episode of the 5th season of Happy Days, when on a dare, in order to prove his bravery, Fonzie agrees to jump over a shark on water skis wearing his leather jacket. We think there's a parallel to what we're seeing in monetary policy in Europe and in Japan. We think the central banks of these two countries have jumped the shark. What do I mean by that? Well, let's look at a graph. This is a graph, and the yellow line is showing the euro in US dollars. Anytime you see that yellow line going up, it means the euro is going down. This is what the central banks want. The white line is the European stock market. So you want both of those lines to be going up. Stocks up, euro down. So how are they doing with that? Well, initially very well. If you look on June 5th of 2014, the ECB lowered their rates into negative territory for the first time. You can see that euro depreciating with that yellow line going up. On August of 2014, ECB President Mario Draghi first starts talking about quantitative easing. Again, that yellow line moving in the right direction. And then finally, in January of 2015, they go ahead and they announce a big quantitative easing program. Everything moving in the right way. The euro is going down, stocks are going up. Perfect. This is monetary policy working. And then it looks like they jumped the shark, because the next thing they did, if I can get this to work, on December of 2015, the ECB cut rates again and extended QE, but you see that yellow line has now started to go down. The euro is going up. Look at that white line. It's going down. Stocks are not liking what's happening. The ECB, the Europe, has jumped the shark. And then finally, November of this year, they cut rates again and add more QE, and again, you see the euro is not responding the way they want it. So a signal that they have indeed jumped the shark. Let's look at Japan. It's the same thing, and it's the same graph. The yellow line is the yen. You want to see that line going up, meaning the yen's going down. The white line is the Nikkei stock exchange. You want to see that moving upwards as well. April of 2013, the Bank of Japan announces their first quantitative easing program. The yen starts going down. Perfect. Again, in October of 2014, they announced more QE. Yen's going up a lot. In fact, look how much, yen's going down. Look how much that yellow line has gone up. Look how much the yen has depreciated. And look how much the Nikkei has been going up. Monetary policy working very well. But then finally, January of this year, the Bank of Japan shocked the financial markets. After 1 week before saying they would not consider negative rates, the Bank of Japan announces negative interest rates, and the yen started going up and stocks started going down. Japan has jumped the shark as well. So what does this mean for the Great Escape? What does it mean for US monetary policy? So this next, let me back it up. One thing, though, is bad. We can see that monetary policy has jumped the shark, but the other thing is it's not working. We're not seeing economic growth globally. And what this graph is showing, it's showing the IMF, the International Monetary Fund's estimate of GDP growth worldwide in 2017. Back in October 2012, they thought 2017 growth would be 4.5%. January, they'd moved that down. January of this year, they'd moved that down to 3.6%. So you see, growth is going the wrong way. Estimates of growth are going down. In fact, just last week, the IMF put out a new report called Too Low for Too Long, and they again lowered growth rates for 2017. But what I want you to focus on is the segment returns. In the US, 2.5%, the euro, 1.6%. They believe Japan is actually going to contract. In Canada, at 1.9%, actually isn't that bad. It's higher than one might have thought. The key here is, look at US. It's not that much different than Canada or Europe. You're not even seeing that much of a differentiation, and yet apparently the US is supposed to increase interest rates. We see the same issue in inflation. You see, inflation, US is higher than Japan and Europe, but not that much higher, and well below the central bank target of 2%. This is very important. This is a very important concept to understand because you need economic growth or inflation in order to grow your economy greater than you're growing your debt. If you don't, then you're not able to deleverage. And this is one of the keys we need to see in the world right now. Governments have too much debt. They need to deleverage. If they're not doing it with real economic growth, they have to do it with inflation. It's why central banks are putting such a premium on generating inflation. There's no way they can deleverage if they don't get it, and they're not getting it. So this is a problem. So what does this mean for economic, or rather monetary policy in the United States? This is called the Fed dot chart, or plot. Each dot represents one Fed governor's forecast for what he believes interest rates will be at the end of 2016, 17, and 18. The green bars is an average, and you can see 2016, Fed governors believe by the end of the year, the Federal Reserve was going to increase interest rates 4 times or 1%. That was back in December. Literally 3 months later, they've moved their forecast considerably lower. Now they believe they may raise twice or 0.5%. But what's interesting is the market, which is this red line, believes they will raise rates a lot less. In fact, the market believes you might see one 25 basis point raise. Maybe you might not see anything. And this difference is causing a lot of volatility in the market. And in fact, why is there this difference? It's because if the U.S. is the only country in the world increasing interest rates, it's going to put a lot of upward pressure on the U.S. dollar, which it has. That's going to slow economic growth. As I said before, with the Great Escape, the U.S. can be the first out of the tunnel, but the others have to follow. They can't support world growth on their own. So you need everyone else to follow, and that's not happening. And in fairness, if you've seen the movie The Great Escape, you know that, yes, 76 Allied airmen escaped, but 73 were recaptured and 50 were shot. So The Great Escape, in that scenario, doesn't have a good ending. In this scenario, possibly we're seeing that it might not.